Good morning, everybody. Going to talk about some stocks and options today. Here is this week's Swinging for the Fences article that you got Monday morning. By the way, Kirk Spano, May 12th, 2020. Fundamental trends and other stuff. Some basic parameters for swing trading. Make sure you read that. Some of the swing trade ideas. I put in Nobel Energy just because they were showing up on my screens as one of the weakest companies out there. But there's several others that you can take a look at. You'll want to take a look at their option chain, which I did not do ahead of time. Somebody informed me that the options were all expensive. I don't doubt that that's true. So the thing to consider with Nobel Energy and many of the other companies that I've highlighted is I think a lot of these oil companies are going to go to zero. I think they're going to go bankrupt. Maybe they go down to $1 and get hugely diluted. I think that's probably the case with Occidental. I think Occidental goes down to right around $5, maybe less. And then they're massively diluted. They're already diluting over there at Occidental. They're paying Warren Buffett in shares rather than cash on his preferreds. And Carl Icahn sits there and quietly, not so quietly really, is remaking the board over at Occidental. So I think you're going to end up seeing Carl Icahn and Warren Buffett and 5 or 6 institutions end up being the new owners of Occidental at some point, as the shareholders either get diluted into oblivion or wiped out completely. Either way, the downside on Occidental and Noble, and probably 20 other oil and gas companies is 90 to 100%. Not that they're 90 to 100% lose, but if they lose, they're going to lose 90 to 100%. They're literally a whole bunch of stocks going down to zero. So you can find that in the energy space across the board. So I was playing with the Occidental chart and just drawing Fibonacci waves and just trying to see where the overlapping support was. You notice it right here, 2 lines that met at the same place. So when you have confluence or overlapping lines, and I didn't draw very many, I only drew a couple, look at how it bounced off of that spot 3 times before breaking through down to the bottom. And Occidental's rebounded off of their bottom from about 835 up to about 14. I think it's going to turn over and it's going to head back down to around 5. Why is that? Simple answer is that even with Saudi Arabia cutting an extra 1 million barrels a day for a month or two, the demand for oil is still about 3 or 4 million barrels less per day than what's being produced. So by the end of the year, here's the catch-22 for the shale companies, is they have to cut their capex dramatically in order to try to help alleviate the oil glut, which they will not be successful doing because the oil glut is the biggest in history. I'm writing about it right now. I would be shocked if the price of oil is over $40 before next summer of 2021. The only thing that would bump it up to maybe around $60 a barrel is that war with Iran, between Iran and Saudi Arabia, us and Iran, who knows, but some sort of conflict with Iran. And even that's not going to drive the price of oil up to 80 or 100, I don't think. Why? Again, biggest oil glut in history. If the demand for oil was 1 million barrels a day more than the supply, it would still take about 5 to 6 years to go through the glut. Think about that. So, I mean, there's just absolutely no risk of the price of oil skyrocketing. Even if we blew up Iran, or Saudi Arabia blew up Iran, or there's some conflict that knocked another 3 or 4 or 5 million barrels a day of oil off the market, and then demand magically rebounded within the next several months to what it was 6 months ago, which it won't. But let's live in fantasy land for a while. Let's live in fantasy oil bull land. Even if the price of oil responds to that temporarily, it just won't stay that high, because it would take a very extended period of oil supply remaining low. And we know that the shale guys aren't smart enough to do that. And we know that Russia doesn't have any willingness to actually have lower oil production. All they're doing is holding back on CapEx and holding their production relatively steady. So their oil production drifts down over time if they hold CapEx, below expansion levels. And the interesting thing with Russia is that when they made the cuts deal a few weeks ago, that deal was based on October 2018 production, and from Saudi Arabia and Russia producing 11 million barrels per day, which they hadn't been doing since 2018. So the real production cut was only about 6 million barrels a day, even though they advertised it as 10. And now with Saudi Arabia cutting temporarily another million barrels per day, now it might be up to 7. And if a couple other countries follow suit, maybe 7.5 million barrels a day cut. But the demand destruction was over 15 million barrels a day. So there is the possibility that with so many people working from home in the future, and you're starting to get announcements across the board that companies are just going to leave it that way. Nationwide Insurance, big insurance company, they said that they're going to go to a hybrid model where most people work from home most of the time. And they just go to their hub offices from time to time for training, for updates, for meetings. But for the most part, most nationwide insurance people are going to work from home. Here in Milwaukee, Northwestern Mutual Life has all sorts of extra office space. They developed an office complex here in a suburb of Milwaukee about 7, 8, 9 years ago. It's a very new complex. It's where the drive-in theater used to be, which we suddenly need. And they're going to probably rent that all out. Either that or they'll rent out their new office tower in downtown Milwaukee rather than consolidating, and they'll just have 2 campuses for different services. But they don't need their office space, and they're going to be renting it out. So you're going to see a lot of changes to the office real estate market to the point where, and I'm going to cover this over a couple of days, but I will give you one of my short picks here at the end in real estate. You're just going to see a ton of retail and office real estate just get crushed here in the very near future. This rebound is an opportunity to escape. The amount of money that they're going to have to spend to redevelop properties that they didn't plan for redevelopment is going to be massive, just massive amounts of money. So you're going to see REITs across the board start cutting their dividends. A few already have. But companies are trying to hold the line right now. By the end of the year, it'll become apparent that they can't. And seeing as the COVID-19 infection curve is just going through the roof now, if you exclude New York City, COVID-19 infections are going up across the board. And again, I had that chart for the southern states a while back. It's localized there. The biggest infection rate increases: Florida, Georgia, Texas. South Carolina. But it's starting to be everywhere again. You know, Chicago's flaring up again. Detroit's flaring up again. Milwaukee's holding steady. I don't know if I expect that to last too long because the county to the west of me just seems like they don't care. Very ideologically driven county, and they're not wearing masks, and they're going out and they're hanging out at bars that are supposedly closed, and they think it's cool to call it a speakeasy. So, you know, I don't know what it's like all over the country, but I know enough from my phone calls that there's a substantial part of the population that pretty much is guaranteeing the second wave is going to be sooner and bigger. Anthony Fauci is going to talk about that to Congress. I believe the Senate today or tomorrow, but it's coming up. So, in any case, go back to Occidental. I think it goes down to around 5 or lower. There's not really a measurement level below there for us. So I would say that if you wanted to buy puts on Occidental, maybe a put spread. I don't know that it's a horrible idea that you end up owning it at maybe $1. But I wouldn't bother. If I want to own any of these oil companies, I'm going to buy their bonds. Their most senior bonds that are going to get me as part of the ownership of these companies down the road. And there is an argument for wanting to be the next class of shareholder with these companies. And it goes like this. Companies that have substantial conventional assets, like Occidental, will be able to keep their CapEx low long-term once they wipe out a bunch of debt. And then just basically milk the end of the oil age with their almost no-cost conventional assets dripping in oil nonstop. And then when it's opportune, they can spend a little bit of money on shale plays where the economics make sense. So companies like Occidental post bankruptcy are going to be pretty attractive. The only real way to get in on that is as a bondholder now. So you buy the bonds, and you need to buy them now because they're about to go up in price. And that's something that we'll also discuss in a minute. So you can go ahead and take a look at these charts, and I mean, they're just brutal. Go way back here to financial crisis low. Just make some Fibonacci lines. And this is called a retrace. They have really good tutorials at, let's just look how far down that comes. At TradingView. So the tutorials at TradingView will teach you why these sorts of things are important. Now, when you do the Fibonacci's, you go to some of the bigger moves. You just see where they end up. Where is their overlap, right? Go back to the same spot. Being on the line is all that's important. On here. So you start seeing, okay, well, that's that. Maybe this one holds. Maybe this only gets back down to $3 a share if it doesn't go bankrupt. And you can play with all sorts of other levels. And then you can just erase the ones that are all by themselves. Look at that. That ended up down here. See, look at that. You can take another trace. And what you're doing is you're going from a rally down to the correction. We can go all the way to that one, or this one is probably the more appropriate one. you start seeing, well, look, it just kept on breaking through all these levels. And when you change this to a daily chart, it becomes a little bit easier to see. That screams out that was the spot, right? $2-3. Get down to. Got down to under $3 a share. So I would expect Noble Energy to do the same thing. It'll come back down. So if you can get a good price on the options, I think you're going to do all right there. So maybe you buy an option at a put at $7 or $8. You know, you have to take a look and see what those would cost you. And we know that if Biden wins, he's bad for oil, right? That's maybe not true, but that's what everybody thinks. So you can buy the 750 puts for under $1.75. So that means the stock gets under 6, you start making money, and if it goes bankrupt, you make 400 or 500%. So I think that is something to keep an eye on. Now let's go out to the indexes before we get to bonds. And again, I've just been playing with different Fibonacci levels, see where the overlap was, see how that relates to market structure, right? And you need to respect market structure. So here's a double top, triple top, right? Triple top, and then it finally breaks out. The orange line, I couldn't think of a better color, is when President Trump was elected. The orange line, get it? And it looks to me like the market wants to erase the entire gain. So it looks to me like the entire Trump rally, which was almost erased during the crash, ends up getting erased. And the C wave on this, if you're using Elliott wave theories, you know, and within every wave of Elliott wave, there's more waves and then subwaves, and you know, so I don't bother charting all this stuff. I just kind of respect that it's out there, and I look for the patterns, and I watch other people do this. You know, I watch Avi Gilbert's people and 2 or 3 other Elliott wave traders, 3 if I remember to see the third guy. But I you know, I follow the Elliott wave traders, and the thing about them is that they're respecting market sentiment, but there's not a whole lot of science behind what they're doing. It's just repeating patterns, and the idea that repeating patterns keep repeating. So that's really what you're looking at there. And the Fibonacci's tell you the same thing, because within nature and within psychology, for whatever reason, we gravitate towards symmetry, right? Think about how we look at things in nature. What do we think is beautiful with the opposite sex or same sex, whatever? What we think is beautiful is typically symmetric. That's why certain artists, you know, throw one out there, some of the abstract artists, right, they got a lot of criticism up front, and then we recognize the genius of what they were doing is they were reminding us, hey, you know, sometimes you have to look beyond the symmetry. So that's really what all these patterns are about, is where is the symmetry? Because if you know where the symmetry is, you're going to have a better understanding of the market psychology, which in the short term is a beauty contest, right? You've heard that saying before. So the symmetry, the beauty, all those things go together for the short-term beauty contest that is the stock market. Because in the short term, that's all it is a beauty contest. In the long term, it's a weighing machine, as Warren Buffett would say. In the long term, eventually true value wins out. But in the short term, it's trading. And that's what you have to decide. Do you want to be a part of this short-term trading? And if you're going to be a short-term trader, then you better understand the concepts that go into this. You can't just say, I want to follow Kirk. I'm going to do what his trade is. I'm not always going to tell you. I'm going to tell you what I'm looking at, and then you have to go out there and start playing with these charts and manipulating them and learn the method that's going to be easiest for you to understand and apply on a consistent basis, because there's 100 of them. So I think that the S&P 500 gets down to somewhere between 2,100 and 1,800. It could go a little lower, right? There's reason to think that it could go a little bit lower. It could even go all the way down to, the here. Not really a fib level in there, but who knows? That's why I think it probably stops around here. I don't think we get much below this area. So again, in the crisis scenario, we can go lower. We can break through these levels and then just keep on going down. And I don't think there's any rule, I haven't read it, that says we can't get down to these levels. I mean, this would just blow my mind if we went all the way back to the lows from the financial crisis. I mean, I don't really think it's possible, but it could happen. So I'm just going to erase that. I really don't think we can go below this level here. Just going under 1,000 on the S&P 500 would be astounding to me. That would mean that this pandemic got so bad that we got down to producing food and waiting it out. And I don't think it's going to get that bad. I do think that the second wave is essentially starting already, or the first wave is just getting extended extremely long. We're starting to see in Wuhan, China, that they're getting cases again, like around 200 yesterday, I guess is what it was. This is something that's not going to go away quick. And this is the title of an article that I'm writing right now. Reopening doesn't mean open. So this phase 1, phase A, whatever it is, where you have partial opening of some businesses, we're going to be in this phase for a very long time, probably through sometime in winter, maybe until next spring, April, May. We have to learn whether there is suppression from ultraviolet light during the summer months, because the warm weather and the humidity don't seem to be doing it in other parts of the world. But, we'll find out if the UV light helps. I'm not confident at all that we get a V-shaped recovery. I think that anybody hanging on to that is sadly mistaken. And the reality is that we're going to have unemployment rates over 10% well into next year, if not the year after, because the kind of the low-end service end of the scale is that, those people just aren't going to get their jobs back. How many waitresses and bar staff do you need if you're being told, you're allowed to only operate at 25% or 33% capacity? So I think it's very important to keep our eye on the ball here. All the correlations in the market have been related to COVID-19 news, and there's been a lot of hopium based on the idea that there could be a vaccine. I just saw a study, another one of the machine learning, artificial intelligence things, that said that there might be a couple of vaccines by the end of this year that in the lab look good. That still means that they have to go through testing and production. So my idea that we don't have a mass-produced and mass-distributed vaccine until the second half of 2021 seems to be getting validated. Still could come in the first half, I think. You know, I like I said, if a miracle is going to happen, it'll be with the biotech people. You know, presuming they don't accidentally infect us with something worse. But you know, it seems to me that sometime next year there will be a vaccine that gets mass produced and mass distributed, but it's not going to be this December. It's not going to be January. It's going to be more like, you know, April, May, June at the earliest, but probably more like, you know, August, September, October. And in which case, we'll try to give it to the kids first so they can finally go back to school. So we'll see, um, and we'll see what goes on. I do think that the political gridlock is a problem as well. I was surprised to see the Republicans back off on doing another round of stimulus. I wonder what happens if they don't start sending out more $1,200 checks. I know that my son and girlfriend just got their my fiance in waiting. Um, you should see the ring that I'm designing. It's pretty cool. Um, Cheap though. I'm a cheap bastard. Um, you know, only a couple weeks salary. But the idea that the economy can hold up with people making so much less money is really, you know, it just, I remember 2008, 7, 8, 9, 10. You know, I drove through the country all those years, especially out east in Pennsylvania. Pennsylvania still has got problems, you know, parts of Ohio too, Indiana. You know, there's a lot of Rust Belt states that are not in great shape still, and this hurts even more. And then you throw in all the tourism that's getting crushed right now, and all the entertainment, you know, and the office is, you know, undergoing massive change. Real estate getting hit, oil getting hit. You know, I just don't know how much money we can print. Um, and I really do believe that by later this year, we're going to be in a stagflationary environment. I don't know how that we avoid it. And that's if, you know, the Fed keeps doing what they're doing, which I think that they will. And they're not going to get a lot of help on the fiscal side. You know, it'd be great if all the things that we know will get passed next year, one way or the other, it'd be great if we passed them now. And I just don't see it happening. So I think that the political gridlock is going to hurt us. In addition to the fact that we have not bent this curve down, and that is probably a massive mistake. So, as I told you, the stock market likes to gravitate towards symmetric areas, round numbers, 3,000 on the S&P. I think there's a good chance that the S&P gets up to that 300, you know, SPY gets up to 300. But remember, the traders know that too. So they might be thinking, hey, let's not quite get it to 300 before we turn it back down. So between now and 300, I'm going to be nibbling on puts on the S&P 500 and on IWM. Because IWM has got some big problems. So I would say that you should be nibbling on puts on IWM and on SPY right now. I'm buying puts to autumn. I'm not going to go all the way out to January. I don't want to pay for the time value. And if I'm right, within a few days of Joe Biden being elected, which is, I think, the base case scenario at this point, you know, the market will start to rally. Why? Because everybody's going to know that the mother of all stimulus plans is coming. It's going to make TARP and shovel ready and all those things look quaint and tiny. And we're going to see a $3 or $4 trillion stimulus early next year. My guess is 3 point something. It'll have a 3 handle. Could have a 4 handle. We'll see. And then Trump's going to go, look. They did the infrastructure. I asked for 4 years. Well, you remember Obama asked for for his second term. He asked for it too. So we're probably a decade behind on doing all that infrastructure that we need. And we have to remember, we have to redo the entire water system in this country. So, there's going to be an argument to be made for desalination coming on big time here in the short term. Not the very short term, but getting it rolling. Because if we know that the ocean levels are rising, what's a smarter way to mitigate that and solve our water problem than doing desalination, right? Pull water out of the oceans, bring it into the aquifers or right into the water system, one way or the other, and you are reducing, sea rise, which will mitigate the amount of money we have to spend on sea walls and everything else that they're doing in cities like New York and Miami and everywhere else. I'm going to buy puts at about 270 because that's the first level that we get to where you might get a little rebound. So your put premiums should go up as the market comes down. You can trim those puts if there's not big momentum to go through this level. And then it'll go up a little. You can buy them back if you want. I think that day trading SH is worthwhile. I think that day trading RWM is worthwhile. But again, you have to start learning, if you don't already use it, some technical analysis. You can't just say, well, I'm going to do this because he did that. Because then you don't understand, you're not engaging in proper risk management, scaling in, scaling out. So again, I implore you, just go to TradingView, take the technical trading classes. If your brokerage offers good ones, I think TD Ameritrade does. My guess is Fidelity does too. I know Schwab does. I mean, there's all kinds of classes out there where you can just take the basics. And the reason why the basics work is because 80% of the people don't use any technical analysis, right? 80% of the people just set it and forget it. So all you have to do is learn the basic stuff, avoid competing against the pros, and just take a little money from, from all the people who don't use any analysis at all, which is most investors. 4 out of 5 investors don't do any analysis at all. It's just 401k contributions. And that's another reason why SPY, just to remind you, another reason why SPY is going to look really bad at some point. Those 401ks are going to start getting cashed in, and we already know that the contributions are lower. So that's and the buybacks are ending. There's not a bull argument out here other than, well, what about the Fed? That's the only argument out there. So let's talk about the Fed and what the Fed is doing. The Fed says it will start buying corporate bonds, ETFs on Tuesday. I presume that they are. So here are the three bond funds. I'll give you 3, 2 of them that I'm buying. So I'm actually keeping my cash in bonds again, just for the short term. I wanted to make sure that this fund, the Fed was going to do what they said they were going to do. I didn't want to front run that because I didn't know. So I did miss out on some of this, just like I did before. But the part of the bond market that's going to get the majority of the Fed money is the BBB bond market. So the low end of investment grade, and then also the top end of junk. So the fallen angels are stocks that went from investment grade to junk status in the last month or two. And those are eligible through March something. There's a couple days before Occidental turned to junk. So Occidental's not eligible, but everything that went junk before that is. So the AAA bond market, if you want to use a mutual fund, this is the bond fund to use. I've already put it into some accounts for people. Yields about 4 or 5%. I don't know what it is today. But go ahead and take a look at this PIA's Triple B Bond Fund. That's probably the absolute best one for getting money from the Fed if you want a mutual fund. I am taking a little bit more risk because I mainly have equity investors, and I am going to use the Fallen Angel Fund from Van Eck, and I'm going to actually use the high yield iShares high yield fund. So I've bought both of these. They both yield 4 or 5%. This says 5.48. I think it's a little lower as of today. And I believe that you have about 10% upside. So I think it'll get back to its highs relatively soon. And you get to collect that dividend. Once it gets into the middle 80s, though, you probably sell it. Because there's almost no upside at that point. And if the economy gets substantially worse, then it can fall back down. So your margin of safety is to about here, middle 80s, middle to upper 80s, and then probably get rid of it. And don't go, oh, but I want to make that 4%. Oh, shut up. Okay? This is a capital gains play, and you get a couple dividends along the way. And once it gets up here, get rid of it. Same with Angel, right? So the play is to about 30. Collect 1 or 2 dividends along the way. And then you sell it because only bad things can happen after that. Or nothings and bad things. You know, let's hope for nothings, but probably bad things. All right. So those are the funds. Go ahead and buy them. I've been buying them all morning. I've been buying both of these. And if you prefer a mutual fund, I really think that this is probably a really great fund for you. So I have a half a dozen emails to send out. But if you're one of the folks who I'm doing an investment plan for that I've been slacking on because there's no hurry, you know, you can throw some of these bond funds in there as placeholders for your cash. The Fed's going to do a lot of work here. And this is where most of the money is going to go. So the question that we should ask is, do we think the Fed's going to start buying equities? And I think the answer is no. I don't think it'll happen under this president. I think at this point it's too late. I don't think you're going to get because that would require a change in the law. And the Fed can't just do it. You know, they weren't allowed to buy these bonds until they changed the law. And nobody had the stomach to say, go ahead and buy equities too. So what the Fed is doing right now required a new law. Had to go through Congress. Again, I don't see the Fed buying equities. I do see the government buying equities eventually, but I think that'll have to do with Social Security. I think at some point you see 20 to 30% of Social Security withholdings put into the S&P 500. That'd be my guess, because over the long run, it's just the smartest thing to do. But that'll also have to do with a normalization of interest rates. So when all these come down, all these things come down. Another article I'm writing is the big picture is bigger than you think. Ultimately, that 40 to 50 trillion, and I keep going higher on that because the numbers just keep getting bigger. You know, between the Fed balance sheet and the deficits to the retirement system, at some point, 40 to 50 trillion dollars gets printed, which should double, right? The price level for everything should double from assets to what you're buying. So, you know, there's going to be a lot of inflation. However, because of the nature of how they'll do it through extended payment systems like pensions and Social Security, you're going to see, and bonds that take 20 and 30 years to mature, you're going to see a doubling of the price value or devaluation by half over a 30-year period. And that's only about 3% per year in inflation. So you take that 2 or 3% per year in inflation up against the 2 or 3% a year in deflation that we have, and it all pretty much washes out. You avoid becoming a banana republic, even though you printed two economies. But at that point, you're going to see interest rates go up substantially. You will get an almost instant normalization. So whenever you first hear them talk about this legitimately, and it's on the back burner now. People talk about this, but it's politicians don't, not yet. At some point, it gets into the mainstream. When you start seeing it in the press, when you start hearing politicians talk about, why don't we create the lockbox? Why don't we bail out the Fed? When they start having those discussions, you sell all of your bonds. Because interest rates are going to go up 2, 3, 4, 5 points quick. And that'll just murder bonds. And then you have this reset, and then you get 30 years of normalcy, before we screw something else up a couple generations down the road, because we forget everything. We don't even remember the Great Recession anymore. That's only 12 years ago. So, all right, go ahead and buy this. Angel and this. Now, if you want something less assertive, these are some of the investment grade bond funds that you can buy. Right, so I have the pro membership over at a ETF database. Vanguard Intermediate Term Corporate Bond, the iShares Intermediate Term Corporate Bond. You don't want the short-term ones. Go ahead and get a little duration on those. But these intermediate bond funds, and even there's an argument for the long-term ones, because I don't know that we see the normalization this decade. Borderline on that. But these are all bond funds that you could use if you don't want to go down into the junk range. These only have maybe 6-7 points of upside, and the dividends are only, the interest rate you're getting is only 2 or 3%. But they're safer. They're for sure safer. But I just think with what the Fed is doing, that you can go downstream and capture a couple extra points on your dividend payments for a while, and you get a little bit more upside. And then as far as these puts go, again, buy a spread. If you're going to short oil companies, pick 4 or 5 to short. And then the one that goes to zero makes you all your money back. And then the second one that gets crushed, you're now in a very significant profit. So I think that Occidental, I think that Noble Petroleum, Noble Energy, Occidental Petroleum, there's a bunch of them out there. The companies that I wouldn't short is I would not short, I think you can short Exxon, because when that one tips over, it's going straight down, right? Because everybody will finally bail, including the institutions will bail first. They've already been bailing, and people still hold on. But avoid shorting Pioneer, Concho, and Parsley. And what's the fourth big Permian only play? But the Permian pure plays, I'd stay away from shorting. Remember what I talked about last fall? I said that at some point it'd be interesting if somebody just came up with a company, Permian Resources, and they merged a bunch of Permian oil companies, and they started doing wind farms and solar and CO2 and water. That makes so much sense that all you have to do is have enough pressure on the executives and it could happen. They take their golden parachutes and they go away and they create a better company. So I'd stay away from shorting the Permian pure plays. But any company that's big in the Rocky Mountains, the Bakken is down to 5 frac spreads, right? So there's almost nothing going on in the Bakken. So I think you should short Continental, Nobel. Occidental, well, who else? I mean, I think you could even take a shot at shorting Devon because they're big in the Rocky Mountains. But, the Rocky Mountains are just a horrible place to be a driller at this point. And Occidental is in hip deep there. And Occidental had their Algeria. One of their deals to sell to Total was bound, right? They can't do it anymore. They got turned down. So that's a spread of companies that you can take a look at. And then the Reits, I will tell you something. I think this company is going to drop at least 50% from here. I think that you're going to see a Simon Property Group go to all-time lows. Right? I think they're in big trouble. Big trouble. So they're going to cut their dividend. I think they're going to cut it to zero. They cut their dividend here. I don't remember what they cut it to. But they are in so much trouble right now. It is off the charts. I warned everybody. Up here about Simon. Told you to get away from Simon. That in a recession, they're in trouble. But look at that. Drop, what is that? 60, 70%? And I think it's going to go down 60, 70% from here. And I told you stay away from Simon. So, people don't want to hear that sort of thing when they're in it. Well, look at that chart, right? Look at that. What on earth makes you think that a real estate investment trust should do that? None of them should do that. So here's the problem with Simon. Simon had been budgeting for a certain amount of rehabs and upgrades. Well, so the mall model, I don't know how they're going to survive right now. I mean, for the next year or two, think about all the companies that go out of business right after Christmas. There's always a wave of retail companies that go out of business after Christmas, right? I think you're going to see half of their tenants go bankrupt, give or take. I was looking at their list of tenants. They're going to lose half of their stuff. A lot of those companies are going to cut their tenancies from 3 stores or 4 stores or 5 stores in a city, depending on how big the city is, to 1 or 2. And they're going to do a lot more stuff online. And they're going to need smaller spaces. Or maybe the space, maybe they have to have the bigger spaces, but only 1 or 2 of them, just to keep social distancing permanent. With more dressing rooms that are private. Try this on. We only have 2 in this size, so you can't have it. But we can get it to you tomorrow from our warehouse, right? Or 2 days later. Or you can pay double to get it right now and can't have a sale. No sale price on anything in the store. There's going to be a change in those models. So with Simon, they're going to have to sell off a whole bunch of properties. And the problem is who's going to buy these empty malls? We're going to have more than enough office space. So what are these going to get converted into? I have some ideas, but they're not cheap, right? I actually think that malls, especially the second level of malls, can turn into the new offices, right? You turn those into new offices. And, for like 1 or 2 companies to take up a whole mall. And now you have all these segregated spaces. And the big broad hallways. And you can put in green space in the middle of the mall with UV lighting. I think there's going to be a major change to what malls are. And only specific destination malls will stay retail and entertainment. Because, again, COVID has changed the landscape probably forever. Not that malls will go away entirely, but I think the strip mall is going to be a lot more popular, right? 1 door from the outside, right? In Wisconsin, that's what we're allowing to open. If you have a shop in a strip mall that has a direct door to the outside, we're going to let you open and have 5 customers at a time, depending on how big you are, I guess. So, but these enclosed spaces, I mean, those might not open for a year. Seriously, they might not open for a year. So I think that you know, you have to keep an eye on this and take a look at Sars in Hong Kong. A professor from Hong Kong emailed me today. I said, hey, I read your article. This is what's going on. I'd love to keep talking to you. I said, okay. And I asked him some questions. But if you take a look at what happened in Hong Kong after SARS, you know, they have been practicing a type of social distancing for 15 years already. You know, we make fun of them for wearing the face mask because we didn't you know, most Americans are too ignorant to understand why they do it. Oh, it's polluted there. Not really. It's that there's a huge phobia about passing on disease. And I don't think the United States ever gets quite to that. But I think that face masks become a lot more universally used in crowded places. You know, so we'll see what happens. You know, if you're in an open air stadium for a baseball game or a football game, I doubt that you see a lot of face masks. I mean, in Wisconsin, you have everybody with a scarf around their face because by October it's cold up in Green Bay. But, you know, the world's changed. You just have to accept that it's changed again, just like after 9/11. Right? There's a lot of permanent changes since 9/11. The financial crisis didn't really change a lot of things, in my opinion. But I think this will. And Simon is going to have to cut their dividend. And I think that there's a chance they go bankrupt. When you take a look at their balance sheet, it ain't that good. Right? The debt is big. And the only thing that they can do is sell properties. But who's going to buy them? And for how much? So, you know, we'll see. I don't think they go bankrupt, but I think that they come way down in here. So if you wanted to short Simon, I think that you could find a way to short Simon. And we can even do this. Oh, did I mess that up? I think I did. You know, you start playing with your Fibonacci levels. Oops. Clicker's not clicking good. And what would be one of the retracements, I guess, from here? So that first one, I guess you got to try to do this one. It's so far down, I don't even know if these matter anymore. I don't even know how far back we have to go. I'll be real, I have no freaking idea. This is so destroyed. Yeah. If I thought they were going to recover quickly, I'd say that this was a local bottom right in here. I don't think they're going to recover quickly. I think they'll come all the way back down here. I think they break through this level because there's some support here from market structure over here. I think that Simon's probably going down to 20-ish. So that would be an aggressive short. But at this point, if you own Simon and you know the dividend's about to be cut, yeah, get rid of them. Store has the strip malls, right? Those are strip malls. So that's not a mall. That's a strip mall. I like Store. That's where the business is going to go. So, all right, call it a day. It's been an hour. That's enough. I have things to do. If you have questions for Ask Me Anything, go ahead and do Ask Me Anything. And I would encourage you to take a look in the forums. I paid to have my son upgrade this. If you go to the very short list, he's been updating all the companies that we've been following and that are on the very short list right now. So if it was already in here from the past, he updated it with research reports, Morningstar, Reuters, Vickers, right? And what I would ask you to do, because this is just from Schwab, this is who we used. If you have a brokerage, Merrill Edge, Fidelity, TD Ameritrade, Vanguard, whoever, what I want you to do is any company that you're invested in, please help us keep the research reports in here. Update, when you see a new research report for a company you follow, upload it in here. Every company, right, is in here at this point that we follow, or he might, I don't know if he's all the way done yet or not. He said he'd be done by Friday, I think. So I don't even remember this company. We must have talked about it at some point. But CMEX, I think CMEX is a company that I'm going to add back onto the VSL, or I think it's already on the international VSL, because when the stimulus packages come, we're going to need a lot of cement, right? And they're beat to heck right now. So this is an international company that you might want to get into. Also, the investment firm research and letters. So if you have research from a Goldman Sachs or JP Morgan or whoever, please find their thread in here and add it as it comes new. So we've been getting one of our subscribers is a Goldman Sachs. I think a number are Goldman Sachs clients. But yeah, go ahead and put the updates in here, right? Put in the research. And I'm not going to pay him thousands of dollars a year to update this. So if you want these forums to be effective, contribute. Load a few research reports here and there for companies that you're interested in, right? It gets people talking about it. And go ahead and have your discussion in here too. So this doesn't have to be all research reports. If you have a question, you say, hey, I read the CFRI research report and they said this. Can you help me understand that? Or this is what I think about that, being in the industry, or I have a question, whatever, right? NDR is Ned Davis Research. The reason why I had him do Schwab and not TD Ameritrade is Schwab basically had everything TD did anyway, but they also had Ned Davis Research, and I really like Ned Davis. Ned Davis is on it. So in any case, just wanted to let you know the forums are up and running. Lots of updates. The rare swing trading, I don't even know that we need this thread, to be honest with you, because that's what the chat is for. So I don't know. I might close this. Nobody's using it. Ask Me Almost Anything. This is the one spot where I'd say if you want to create a thread, go ahead. But the other places, if you want to create a thread, just make sure that it follows the format, and double check, real easy to do a search. Double check. Make sure it doesn't already exist. I like to spend less of my time doing housekeeping so I can do more research. All right. I will see you in the chat, maybe close to the end today. But I am thinking, where's SPY? Where are we at? SPY is, started out up today, and now it's back down to the goal line. If it rallies a couple points here, I might start tranching in with my puts that I think I'm going to target for October. So 270s-ish October. That's what I'm looking for. And then when a decline starts, I will start buying into SH and hopefully ride it up. But You know, take a look at that. That's just brutal since March 23rd. But if you take a look at the weekly, you get some spikes, and I think we're probably gonna get another spike like that. I mean, that's a heck of a bull market, isn't it? That's a heck of a bull market. And again, somebody was buying calls on SH. Don't do that. The trend's against you, right? This is a day trading vehicle. It's an inverse fund, right? So keep an eye on that. Gold probably gets a little pullback. You know, 140s is probably about as bad as it gets. I can't see this happening. I do know a lot of people targeting this middle 150s range, middle to low 150s. That's not good enough for me to want to buy it. I'd probably want to see one in this range for me to buy it. I just would like it de-risked more than in this zone, right? See the overlapping lines all kind of bunched. I'd want to see it in here for me to buy it. But GDX, tell you what, this just keeps holding up, doesn't it? If the stock market goes bad, though, which I think it will, I do think middle 20s is still probably pretty likely. You'd have to have massive margin calls to get back down towards 20. I think middle 20s just on market weakness, probably pretty likely. If you just felt like you had to have it because you don't have enough, I guess you could buy it in the low 30s. But, you know, to me, I want less risk, right? Warren Buffett says over and over again, the way that you make money is controlling risk, right? It's not about by trying to, you know, the idea that the risk assets make the most money, yes, but the least risky risk assets make money, right? Kind of a paradox. Your riskiest things hit a home run here and there, but usually they strike out. So you want to look for things that are a little bit more sure. Somebody asked me about Newman Mining a while back. And, you know, we bought Newmont. When did we buy Newmont? Well, this whole area we bought Newmont, right? And we got this huge rally. I'm trying to remember how much of it I got in the 20s. I don't think much. No, right in here, right here. I think. What were we buying it at? 31, 32? I think that was the kind of the main price, right? Low 30s. So it's shot straight up. Here's the thing with Newmont. They get S&P 500 money. So when the S&P 500 falls, this will fall as well. I think it's still going to hold up better. A lot of people love it. But from 52 to middle 40s, I think this is the area that you want to look at. And we can take a look at Fibonacci's. I've done this before. And then we go, oops. What's wrong? Come on. Right there. That's the range. Then you take the retrace, so all the way down to the bottom. And you can already see some overlap, right? Let's take a look at the daily. So where did those lines end up, right? That's right where I have the yellow line. And where is my red line? I'm trying to make these solid. Then right above, look at support there. So we can just keep doing extensions. Here we go. This one to there. Oh, dang, I did that backwards again. Where's the bottom? Here we go. Bottom. Oh, come on. Feel like Cartman. Come on. There you go. You do the retrace. So it's from this bottom point. I don't know what that is. Go away. All right, so that is that rally. Here's your trend lines. Top down to the, damn it. There you go. Maybe I was just being paranoid. Do for this one when it's turns over. So take a look at where our lines overlapping. So here, a couple of them right here. Yeah. There's just a ton of support. This whole range is just massive support, right? So I just have a hard time thinking this is going to go very low. And this is about as legit as a breakout as you get, right? So if you get some sort of correlated event, you can get this down in the low 50s. I think you probably nibble on it. If you can get it kind of in this area here, I guess it'd be from like 40 to, I mean, anywhere in this area, you just should be a buyer. Selling puts, massive support right here, right around 40. Right, jitterbugged off this for a while. Rallied, came back on the correction. So here, look at this. You really want a legit bottom fishing. I think it's right there, right? This took massive sell-offs from margin calls to happen again, but it even stopped, right? So I just don't think you can go wrong buying Newmont. And if you can get it close to 40, you are in great shape. But I can kind of, I'll be surprised if it gets back into the 40s anytime soon, to be honest with you. So I think you got to buy it probably in the low 50s. But you keep an eye. If everything's going down, then you let it go down. Just know that right around 40, 41, that's probably about as good as it gets. All right, we'll close on Newmont. Have a good day. Let me save that. And I will see you on Friday.